We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome into Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. As I always start this program, I give you the opportunity to go to the website to learn more about Brian and Arrin and the team. It's deckerretirementplanning.com. But I go there because Brian and the team have set this up for you to go check out so you go to the website, deckerretirementplanning.com. Then there's headings, right? Different topics. You can go to the heading of Safer Retirement Education. There are 12 different things you can download. You want all of them? Download them all. But one of those is Brian's book on retirement, the Decker Approach book. There's 3 principles of retirement book. There's a checklist challenge. I think there's like 36 checklist challenges. If you can check all 36, you might as well retire. I think I could check, and I'm only 65, so why would I be able to check more? But I think I could check 5. So I'm not quite ready yet, I guess, for retirement. There's a sample income plan in there, plus 8 other items that are downloadable. No cost to you whatsoever. So it's deckerretirementplanning.com under the heading of Safer Retirement Education. So Brian and Arrin today are going to get into a lot of different things. They're going to talk about kind of how do we go about figuring out where we're going to pull money from in retirement? What are some of the common mistakes that people make in retirement? And if you have questions about anything they're talking about, or maybe you have questions about something they're not talking about, give them a call. There's no cost. 833-707-3030 is the number. 833-707-3030. Guys, welcome.
Thanks, Mark. We're going to talk about some mistakes and how to overcome them. Just to give people a heads up, listeners, we want to make sure that you don't fall into any of these very common traps that hurt people in retirement. And Arrin, let's start with starting early. I mean, let's get this one out of the way. I know our radio listeners are long past this and know this, but there's some numbers. We're a math-based firm. Let's give some numbers of how important it is to start saving early, putting money aside or using your 401k. If you do get any matching, that's free money. So match what you can. And Arrin, we'll get into if they offer a Roth 401k option, we'll get into why that's important too. But let's start talking about how important it is to start early. Arrin, what are the numbers?
Yeah, absolutely. So everybody understands generally the concept of compound interest, right? The longer you have stuff invested, you leave it reinvested, that growth grows upon itself over a long period of time. That really works in your favor. But sometimes we forget to take those concepts and actually apply some specific numbers to see what the positive outcome of our choices is in the future. So one of the examples here, it starts with investing $5,000 per year at age 25. So if you started a little younger, age 25, $5,000 per year, estimating a 7% annual return. If you did that up until the point in time that you hit age 65, so about a 40-year time span, that $5,000 a year would then turn into about $1.1 million. Now, comparing that for starting a little bit later, if you instead of age 25, waited another 10 years, started at age 35, invested that same $5,000 a year at a 7% annual return, instead of the $1.1 million at age 65, you would then have about $540,000. So not quite half, but almost half of what your outcome would be had you just started 10 years earlier. So for everybody listening, obviously today is the best day to start that. But knowing that those small incremental changes, just investing a little bit more, taking advantage of those 401k matches or other things you can do to get more money into those retirement funds and allowing that compound interest to work in your favor can really benefit you over the long run and as you get into retirement and actually start spending that money.
Good. Glad we got that out of the way. Now let's start talking about the things that matter right now today on how to properly distribute assets. Gosh, there's so many ways that people can improperly distribute retirement assets. Let's start with Social Security. They have a benefit there to take. Mathematically, let's talk about some of the ways that people can shoot themselves in the foot. So, Arrin, what's the growth rate that people get if they wait? Is it 5% a year, 62 to 67? Go through that.
Yeah. So the way that it works is you can start Social Security as early as age 62. And then in between 62 and what's called your full retirement age, which for most people is around age 67, in between 66 and 67, that benefit grows at 5% per year. And then from your full retirement age until age 70, that increase happens at 8% per year. So they give you a little bit of a bump for the last 3 or so years. Now, that is compounded monthly. So people say, hey, do I have to wait a whole year to get the increase? No, every month that you delay it, it does get prorated as an increase. But again, it's 5% from 62 to effectively 67, and then 8% thereafter. So you do get a little bit of a higher benefit by delaying, but that isn't always the best choice. We want to make sure that we're looking at Social Security in the context of everything that's applicable to your financial plan, not just looking at it on an island by itself. So there's a lot of stuff that needs to be accounted for and integrated together to make sure that you are making the best decision based off of your specific financial plan and financial situation there.
Good. Okay. And I think health has something to do with it too. If someone is not very healthy, should they wait till age 70?
Nope. So with the delay in Social Security, obviously you get a higher monthly amount. So let's say at 62, you get, I don't know, $1,500 a month. If you were to wait till 70, it's $3,500 a month. But if you do have a short lifespan, that's going to kind of cut the benefit out, right? If you start at 70, you die at age 75, you got the short end of that stick. You probably should have started your Social Security benefits sooner. So when we are having discussions with clients around what the optimal strategy for them to withdraw Social Security is, there's a couple of things that we need to account for. The first, like you mentioned, Brian, is what the health situation is. Because we do have people that come in and their longevity is not going to be great. Maybe you have a cancer diagnosis, maybe you have other health issues, maybe you just have a track record in your family of a shorter lifespan. So in that circumstance, it's very likely going to be better for you to start your Social Security earlier rather than later so that you can get more years under your belt of actually having withdrawals versus a higher income amount if you were to wait until age 70. So when we run these reports for clients, most of the time, the break even as far as like the benefit for waiting until age 70 happens around early 80s. Usually it's about age 82 or so, where you have to live beyond your early 80s in order for waiting until age 70 to make sense. If you pass away in your 70s or even age 80, it would have been better for you to have drawn Social Security at an earlier age versus delaying until that maximum benefit amount is eligible for at age 70 there. So anything you'd add to that part, Brian?
Nope, I think you covered it all. Let's talk about some very popular, common distribution strategies and why we would recommend neither one of them. First start with the 4% rule. Very, very common. Give the background of how that works, why it was recommended, the logic behind it, and when it works and when it will actually destroy your retirement.
Mm-hmm. So when people are moving into retirement, one of the decisions that you have to make is how do you decide what rationale or decision-making process do you use to decide how much and when to pull out of the retirement portfolio to actually spend as income. So for the majority of people, they're working and saving and building up those assets to actually use them at some point in time. And so when it comes time to actually start taking withdrawals and spending that money as income, you want to have some good rules or decision-making processes around how to do that. Now, one of the most common ways that's thrown out in the industry is what's known as the 4% rule. And essentially the background behind this is people say, hey, over the long run, stocks have averaged in between 9 and 10%, bonds have averaged 5 to 6%. So I'm going to be conservative. I'm only going to pull 4% of my portfolio value out to spend per year. And because that 4% number is below the average growth rate of those other two asset classes, I'm going to be okay. I'm not going to run out of money. Now, the problem with this approach, the risk that people are kind of playing with here, is that approach very much depends upon what's called sequence of return risk. Fancy term for when do you get the both positive or negative returns on your portfolio? Because everybody knows that both stocks and bond funds have both winning and losing years. So if you happen to be one of the people that retire at the beginning of a big bull run in the market, that 4% rule is going to work out okay for you from an asset preservation standpoint. Your portfolio will grow faster than that, typically going to be all right. However, if you are one of the people that retired, say 99 or the year 2000, right before a drop in the market, you're in a really bad position. Let's just take the year 2000, for example. You have 2000, 2001, and 2002, 3 years in a row where the S&P is down all 3 years, total of about 40% drop. If you are also pulling 4% of your portfolio out per year to spend as income, that's an additional 4, 8, 12% down over that 3-year period, meaning that over just the first 3 years you've been retired, you've lost more than half of your retirement savings. Now, at that point in time, that's really, really difficult to be able to recover from. If you're down 50%, you have to have 100% gain to get back to the original value of that asset base. And that's, I mean, in any real world, that's almost impossible to have happen. So when you take a flat percentage withdrawal approach, like the 4% rule, you're essentially just flipping a coin and hoping that the market's going to work out in your favor, especially in the early years. The other problem with this is most of the time, it means that you're going to be spending less per month or per year in income than you otherwise could. Because that tries to build in a large buffer, it means that you are very minimally pulling from your assets. And it doesn't include all of the other stuff that's going to be a part of your income in retirement, right? You're going to have Social Security, you might have a pension, you might have rental income, you might have other sources of income coming in addition to just what you're withdrawing from your retirement portfolio. So when you take a flat percentage withdrawal, like the 4% rule, you're really leaving a lot of those puzzle pieces out of the picture that need to be accounted for to make sure that you have a complete holistic retirement plan. So, Brian, what would you say in addition to that?
I want to give listeners some background on when it works and when it doesn't. So there's been 4 times that the S&P 500 has ever traded above a market valuation of 30 times trailing earnings, only 4 times. One was 1929 and markets traded flat for 17 years. Now, during that flat market cycle, that 4% rule not only doesn't work, but it will destroy your retirement. Second time, 1964, markets hit that valuation level again. Markets were flat for 18 years. Anyone retiring in that period and drawing 4%, that will send you back to work. It hurts you in retirement to be drawing 4% over a flat market cycle. The third time was 1999, November of 99. Markets were flat for 14 years. Well, Arrin, we hit in November of 2021, we hit 32 times trailing earnings. That means that if history repeats, and we believe it will, over the next 10 to 15 years, any passive investment strategies like buying and holding stocks, indexes, ETFs, mutual funds, those will yield a 0 return over 10 to 15 years. Now, a separate conversation is how we at Decker handle that. We use momentum strategies for risk exposure that are created and designed to do well in up and down markets. But for this conversation, this is about how we've entered a flat market cycle and how over the next 10 to 15 years, if you use the 4% rule, it will hurt you.
So if you have questions about, hey, I wonder if we could just use the 4% rule. And back in the 90s when it came to be, it was like, well, it should last 20 or 30 years. Well, it's kind of like the market should be able to give us money if it goes up every year, but that's not how it works. The idea is sit down with a team at Decker Retirement Planning, sit down and come up with a plan and a strategy that makes sense for you and your situation. Do I take Social Security at 62, 67, 70? When do I take it? There's a lot of question marks that you might have as it pertains to your retirement. If you'd like to talk with the team, there's no cost. There's no obligation. There's no pressure. There's no judgment either. Brian's the only one. No, probably Aaron's the only one that's never made a mistake. Brian and I have made some. 833-707-3030 is the number. No cost to you. 833-707-3030 might be the most important phone call you make. 833-707-3030. Just getting started on Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. More right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, if you have questions, something they are talking about or something they're not talking about as has you concerned, give them a call. Let's see if they can help. 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us. And, you know, Brian, the old way to retire used to be because you had Social Security and you had a pension, and then the monies you had in the market, you just lived off the interest. You never pulled from the principal. Can we do that today?
Well, let's find out. Let's talk about it. So, Aaron, in the good old days where, I don't know, a 1-year CD was at 9 or 10 or 11, 12%, you could live off the interest. But nowadays, the 10-year treasury yield, actually, let's go back and talk about that. So the 10-year treasury in 1940 was at 2%. From 1940 to 1980, 40 years of interest rates increasing. It peaked out in 40 years of rising interest rate cycle, where in 1980, the 10-year treasury was almost at 15%. Now, once you get up double digits, you could live off interest if you want. But then for 40 years, interest rates went from almost 15% on the 10-year treasury to where 40 years later, it's interesting how nice, neat, and tidy these numbers are. 40 years of declining interest rates till August of 2020, the 10-year treasury was at 0.47%. 0.47. Many countries had their 10-year treasury with negative interest rates. I've never seen that in my life until then. So now the 10-year treasury went from 0.47 to now we're at 4.3% as of this radio show. At 4.3%, Aaron, how much does it take for you to make, I don't know, let's say $80,000 a year? I tried to give you easy numbers.
So it takes about 1.9, almost $2 million to be able to get $80,000 a year. And most of the people that we work with are probably going to want to draw more out of that than just $80,000 a year. Especially as inflation has been running rampant the last few years, cost of living on things has gotten a little higher. And I would be remiss not to say that is likely to continue, right? Things in the future are going to be more expensive than they are today. And so when you have specific income needs or income wants, obviously in retirement, you want to be able to do the things that you want, go out, travel, spend time with your family or loved ones, go do the hobbies that you want to do. all of that stuff costs money and you want to be able to pay for that. And so if you are following that 4% or rule, or trying to live off of just the interest from some of the investments that you've made, you're either going to have to take on an incredible amount of risk, which could be both good or bad, right? To be able to get the rate of return that you're looking for to preserve that asset base, or going with a more conservative approach, using the 10-year treasury or other fixed rate options that are not going to give you as much income as you need to be able to live and do the things that you want to do. So it's not the best way to approach that.
Well, there's a second problem with it. You've worked 40 years of your adult life to live off interest and to give all your principal to the kiddos.
Mm-hmm. Yeah,
So let's talk about the right way to do it, Arrin. The right way is kind of a compromise where we use distribution planning. So in distribution planning, this is where you have different cash or income accounts, income streams. So the first thing we do is we allocate for Social Security, and we run Social Security optimization reports so that each Social Security income stream is optimized. Are you married? Are you going to take Social Security as a spousal? Are you going to take your own? All of that, we run the math to make sure we optimize every Social Security income stream. Then we go to the other income streams that you might have. Do you have a pension? Should you draw that pension based on one life, or should you have, what's that called?
Joint survivor.
Yeah. Or should you have joint survivor? We need to know mathematically what gives you the best options there. And then when it comes to your portfolio, how do we break that down? Now, Arrin, most of the people that come in and talk to us are happily surprised with the amount of distribution they're able to get from their portfolio. And there's a special way that we do that. Buckets 1, 2, 3, 4, and 5 are laddered principal guaranteed accounts. They each do something different. So for our listeners, Arrin, I'll describe what's in buckets 1, 2, 3, 4, and 5, and then you talk about the 4 key reasons that these are foundational to the planning that we do. So bucket 1 is an interest-bearing account, just a money market account. It needs to be 100% liquid. It pays income for the first few years of retirement. Bucket 2 is a 3-year CD, and we look not just at banks, we look at banks and insurance companies, and we use something called the Wink database that lets us see what the highest earning principal guaranteed accounts are for our clients. So we do the research. We just don't have clients put money in a credit union earning 2%. We have our clients earning over 4% right now because we've done our homework. And then for bucket 2, 3-year, bucket 3, 5-year CDs, we do the homework to find out what the highest earning principal guaranteed CD risk rate of returns are. We plug those in. Then for buckets 4 and 5, those are 7 and 10-year principal guaranteed accounts that are averaging over 8%. So that's where we get the ladder for our principal guaranteed accounts, and we're able to distribute much higher than living off interest because some of the money coming back is principal. So Arrin, I'll toss it to you. What are the 4 key reasons we distribute from laddered principal guaranteed accounts?
Mm-hmm. Yep. So to kind of set the stage for this, like Brian said, we don't view our clients' funds as one giant pot of money from which to withdraw from. We want to make sure that the funds are appropriately broken out based off the use case or responsibility assigned to each bucket of money. So with those principal guaranteed accounts, buckets 1 through 5, we have a few reasons why we put them in there and why we use them the way that we do. The first is the way that they protect the money allows you to have consistency of income over time. So what we are trying to prevent is, hey, market had a great year this year. You can probably spend a little bit more in income, or dang, market had a 30% drop. You better cut back on your expenditures for a couple of years to help recover from that. We do not want your income jumping all over the place, depending upon whether the market had a good year or a poor year. So by withdrawing your monthly distributions from those laddered principal guaranteed accounts, it provides a lot of consistency and stability to the funds that you're taking month over month to spend as income. Nobody wants to have a huge drop in income a couple years into retirement. You want to have some stability in what you're able to spend every year. So being able to have those protected is the big part of that from a consistency standpoint. The second is with a large portion of your portfolio protected. So in these principal guaranteed accounts, we typically have about 65% of your total assets in these, depending upon your plan structure. And with that, it provides a heavy amount of insulation against the market volatility. So there will be market crashes and market volatility in the future. It's just a fact of investing in the stock market. And so when those things come, not if, but when, we want to make sure that you are not having those sleepless nights, that you're not worried about whether your money is going to last as long as you do. We want to make sure that you have the appropriate amount both at risk and the appropriate amount protected. So by having a large portion of the overall funds in those principal guaranteed accounts, it provides you peace of mind and allows you to be able to have a solid plan, a solid financial plan to be able to build off of in the future.
So that first point, Arrin, to summarize, is peace of mind, right?
Mm-hmm.
You're getting your laddered income from principal guaranteed accounts where you cannot lose money. Even if China invades Taiwan, if we go to war with Iran, gosh, there's so many potential burning fires out there. But the first thing is peace of mind. What's number two?
So for the second one, it's about making sure that while still protecting the funds, we get the highest rate of interest on those protected accounts. So like Brian mentioned, for example, bucket one is used as the first income source. After it's depleted, we then shift over and use bucket two, and so on as we kind of take withdrawals out of those accounts from a laddered fashion. So by having them laddered out, it allows us to be able to not only protect the funds, but also get a higher rate of interest on the funds that you don't need as income right away. So the funds that you're going to need in 5 or 7 or 10 years are going to earn a higher rate of interest than those that we need as income in that first year of retirement.
So you think about it, this bucket strategy that Brian and Arrin and the team at Decker Retirement put into place. It is for each individual or each couple that they sit down with, but the buckets are all different because it's about what do you need to live the life you've always dreamed of in retirement, and can we make it happen? Can we help you set that up? That's the idea. It's having a plan and a strategy. Again, to talk with the team at Decker Retirement Planning, it's 833-707-3030, 833-707-3030. Brian and Arrin back with more right here on Safer Retirement Radio right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, the website, deckerretirementplanning.com. Find out where the offices are in multiple states for Brian and the team. Is deckerretirementplanning.com. But you can also go there to take advantage of under the heading of Safer Retirement Education, there's 12 things you could download. A really great place to start would just be to download Brian's book on retirement, the Decker Approach book. But there's 12 things you could download. There's no cost to do so. It's all there for your information. You can always call with questions, 833-707-3030, 833-707-3030. Brian and Arrin talking about why they use the laddered strategy of guaranteed money. It's not a lot of risk involved in that. There's strategies involved. And I think, Brian, you guys were through 2 of the 4 points you wanted to make.
Yeah, Arrin, let's just give a summary of the first 2 points, and then let's start on 3 and 4.
Yeah, absolutely. So the first 2 were that we want to make sure that we have the level of protection needed to keep your income consistent, that we're not drawing income from a fluctuating account. The income that you're withdrawing to spend as your expense pile every month is coming from a guaranteed account, meaning that it cannot have a loss or a negative return. The second one is that we use compound interest.
Which, by the way, that first point is peace of mind, right? You can have the world blowing up and you've got income coming from laddered principal guaranteed accounts. So that first one is peace of mind.
Absolutely. And then the second one is that we use compound interest to our advantage. So where we ladder these accounts out, we typically have 5 different principal guaranteed accounts. We draw from the lowest earning account first, allowing the other higher earning accounts to use compound interest to be able to still protect, but also grow well the funds that are in those principal guaranteed accounts for use as income a few years down the road. So that was number two. The third one here is when we do put these plans together, we have a portion that goes into these principal guaranteed accounts, but we also have a portion that goes into the risk bucket. And the risk bucket is stock or equity based strategies, with the goal being to grow those funds while you're withdrawing your income from the principal guaranteed accounts, so that by the time you need those additional funds, you have allowed the risk account to be able to grow and offset the distributions that you have taken from those original principal guaranteed accounts. So where we have that division between what's protected and used as income versus the risk account that's growing over time, it allows you to be able to not touch those volatile funds to get those high rates of return, so that you can use those accounts or those risk funds as income later. Helps you to be able to have a higher level of spending over the course of your plan. So that's number three. And then the fourth one is that in the rates of return that we project on the plan, we approach things from a conservative standpoint from the ground up. We are definitely not the shoot for the moon and hope to hit it approach. You're not going to see us saying, hey, we're going to get you a 20% return on all these accounts. On the plans, when we're putting these growth rates on the principal guaranteed accounts, we use 1% for bucket one, even though we're earning 4%. For buckets 2 and 3, those are at 3% when we're earning about 5%. And then for buckets 4 and 5, we estimate those at 4%. And in reality, those have been much higher than that, about 7 to 8% as far as the average rates of return there. So over the course of the time we have these plans in place, you're drawing income from them. Our goal is to underpromise and overdeliver, not the other way around. We want to make sure that you have a high level of confidence in the income numbers that we're projecting for you by using those conservative rates of growth.
Perfect. Okay. Let's get into another problem for clients, and that is fees. The average fee, and this is something that people can look up, the average fee for retirees 65 and older that they pay is 1%. Many people pay much higher than that. Some pay lower, but the average is 1%. So let's talk about fees, Arrin.
Yeah, it's typically called an asset under management, or AUM fee is kind of the term that you'll typically hear for that. Again, pretty common in the industry is 1% on the entirety of the portfolio. So for example, if you have $1 million or $2 million, you're going to pay 1% per year on that $1 or $2 million asset balance. Now, the problem with that in retirement is that those types of fees heavily drag on the amount that you'll be able to take as income and then that performance over time. So with our approach here at Decker Retirement Planning, where we divide your funds out into both the principal guaranteed accounts and on the risk portfolio, not only does that help from a distribution structure standpoint, but it also helps to greatly reduce the amount that you're going to pay in fees. So our typical fee on a client portfolio is around 0.3% per year, because our asset under management, or AUM fee, is only assessed on the funds that are held within the risk bucket. We don't charge our AUM fee held on the funds that are held in those principal guaranteed accounts. So again, where we typically put about 60 to 65% of the overall funds into those principal guaranteed accounts, you have a large majority of your funds that we are not charging you an annual fee on. So again, our typical client average fee is about 0.3% because it's only assessed on a smaller portion of the overall portfolio. So not only does that help you to be able to reduce fees, it just means more money in your pocket, more money that you're going to be able to use as income on a month-over-month basis, more money that you'll be able to give to your heirs or beneficiaries. It's just a better way to be able to approach that with the type of distribution planning that we offer here.
Okay. So our clients are saving on average about 70% in their fees. Now let's talk about outdated strategies. How would you feel, Mark and Arrin, if I came to you and sat down as a professional advisor and you asked me what I use for my risk strategies? And I said, well, I use these 5 mutual funds. These are okay. I'm sure there's better out there, but I'll just use these. How would you feel, Mark and Arrin?
I would not be having a second meeting.
Right. And so what we do at Decker is we do the homework. We find out what the highest earning principal guaranteed accounts are, and we look on a quarterly basis we look on a monthly basis to see what the highest earning principal guaranteed accounts are for money markets, 3, 5, 7, and 10-year principal guaranteed accounts. And on a quarterly basis, we look at several databases to see if what we're using can be bested. Is there something better out there? And if your advisor isn't putting in that kind of time, or Arrin, if they're stuck at a firm limiting them, if you're at Merrill Lynch, you get Merrill Lynch funds. You better use those. You're supposed to use those. But we want to make sure that you're dealing with someone who's doing the homework to make sure that your portfolio is optimized. Anything else you'd add to that, Arrin?
No, I think that point you brought up is one that a lot of people overlook. That if you are, especially with some of these big box firms, Merrill Lynch, Fidelity, Schwab, whatever it may be, the advisor that works there is only going to use the vehicles or the strategies or the funds that's specifically under that corporate housing. Now, they may be okay, but are they the best fit for your situation? Maybe, but maybe not. And so where Decker Retirement Planning is an independent firm, we don't have some corporate entity up the ladder telling us, hey, you have to use these specific funds for all your clients. Here's the way that you're going to approach this for every person that walks through the door. It gives us the freedom and the latitude to go out, do our own research, find the best performing investment strategies, vehicles, options, anything that's going to be a fit for your specific plan, for your specific goals of how you want to use the money. That's what we're going to use. We don't have some specific box that we have to shove all of our clients into because it's the only funds or the only options that we have available. So it's one of my favorite things about working here is I'm not constrained by those specific parameters. We have the ability to do truly what is in the best interest of the clients that we're working with.
Right. Okay, so now let's talk about taxes. Taxes are a big deal. And let's start with the proper way to do Roth conversions. So talk about Roth, why it's important, why it's probably easily the most tax advantage strategy for the most amount of people. And then show a side by side, Arrin, of how much money someone would pay in taxes if they did nothing and paid their RMDs, and how much money they would pay in taxes if they used the Roth conversion.
Yeah, absolutely. I love talking through this because it shows a stark difference in outcome based off of how proactive you are with this type of situation. So to kind of set the stage for this, most people, as they are saving for retirement, typically just do kind of the default route where they put a bunch of money every year into their 401k. Their company may match those contributions. They may save a little bit on their own into traditional IRA accounts. But those accounts, 401ks and traditional IRAs, are pre-tax accounts, meaning the money goes into it before it's been taxed. It then grows tax deferred. But when you pull money out, take distributions, you pay your regular income tax rates on those withdrawals. In contrast, a Roth IRA account is a post-tax account. It's money that you pay taxes on first, but then once you get it into the Roth, it grows tax-free. You can pull income out of it tax-free, and it passes to your beneficiaries tax-free. So there's a lot of advantages once you get it into the Roth IRA account. So an example I want to walk you through is comparing two 60-year-old individuals, same $1 million balance in a pre-tax or traditional IRA account. One of them goes the default route of just growing that money and taking distributions out of that account later. The second one does proactive year-over-year IRA to Roth conversions to manage that tax burden on an ongoing basis. So if you were to just keep everything in that pre-tax account, grow that account at a 6% return year-over-year from age 60 until you hit what's called required minimum distribution age, which is currently 73, that account would be a little bit over $2 million, about $2,056,000. Now, at that point, if you're unfamiliar with RMDs or required minimum distributions, this is the point in time when the IRS says, hey, you've had long enough to defer the taxes on this money. They start forcing you to take withdrawals out of the account, and the distributions get bigger as you get older. So that first year of required minimum distributions for this individual would have been about $76,000. The second year is a little over 80, then 85, 90, and so on. So that by the time this individual hit 90 years old, the required minimum distribution is about $183,000 for that year. So here's the drawback with going with this traditional route where you don't do any proactive conversions. The first is that you don't have as much flexibility around when you withdraw the money out. Once you hit required minimum distribution age, you don't have a choice of whether you take those distributions or not. The IRS forces you to take them. If you decide not to do that, they penalize you, and then you still have to pull the money out. So most people are going to have multiple sources of income in retirement. You're going to have Social Security, you're going to have rental income or a pension or other things that are supplying you with taxable income. And if you're also forced to take those large required minimum distributions, it typically pushes you into a higher federal marginal tax bracket. That same problem ensues for your beneficiaries. So you die, you pass that money to them. They also have to pull the money out and pay their regular income tax rates on those distributions. And it usually pushes them into a higher federal tax bracket. In contrast, if you were to take that same amount of money, that $1 million balance at age 60, and do Roth conversions on it year over year, here's what that would look like. So in this example that we have, they do them pretty heavily for the first 3 years, a conversion of $225,000 for years 1, 2, and 3, $50K a year thereafter, so that by the time required minimum distribution age of 73 hits, there are no required minimum distributions. The IRS doesn't care when you pull money out of a Roth IRA because there are no additional tax revenues earned by that. So in that case, that would allow them to be able to have a lot more flexibility over when they spend the money. Again, there are no required withdrawals, so you could pull the money out if you want to spend it. You could do it in irregular intervals where you pull a chunk every couple years. You could never touch it and pass the whole thing to your beneficiaries. You have a lot more flexibility around when you spend the money. The second one that a lot of people don't think about is a lot of our listeners from a tax status are married filing jointly, and eventually one of you is going to pass away. So that means that the surviving spouse at that point is then going to be a single filer. So even if you have about the same amount of taxable income coming in, the effective tax rate, the amount of taxes you're going to pay on that income, will go up dramatically because you're now filing as an individual versus a joint couple. But if you have those Roth IRA dollars from which to withdraw for income or distributions, those do not push your income up because there's no additional tax due. So it helps you effectively manage that tax burden over time. So from a side-by-side comparison standpoint, let me show you some numbers. For the traditional route where everything's in an IRA or a pre-tax account, over your lifetime, assuming a death age of 90, you would pay a tax bill of about $656,000. Pass that money to your beneficiaries. Their bill's about $807,000. Total taxes paid on that money is just over $1.4 million. And the net value the heirs would receive is also about $1.4 million. Contrast that with the proactive IRA to Roth conversion strategy, where you would pay about $305,000 on those conversions, pass that money to your beneficiaries. They would have a small bill of about $28,000 for a total tax bill of about $330,000 versus the tax bill of over $1.4 million on that traditional route. So you've saved over $1.1 million in taxes. And then you have a comparative difference between the net value that your beneficiaries or your heirs would receive. The Roth conversion strategy would give them about $4.2 million versus a traditional route giving them about 1.4. So again, this is likely to be the largest tax saving strategy available to you for the remainder of your life, and it will greatly benefit both you and your beneficiaries if leaving a legacy is a priority for you there.
Yeah, that's great numbers. Really interesting, Arrin. And if any of you would like to learn more about this, boy, does it make sense for me to do a Roth conversion? If you're in that situation, obviously it does, but we're not all in that situation. So does it make sense for you? Roth conversions make sense for a lot of people, but not everyone. That's why you talk with a team like Decker Retirement Planning to figure out where you fit in on all of this. 833-707-3030 is the number, no cost to you. 833-707-3030 might be the most important phone call you make. 833-707-3030. Brian and Arrin back to wrap up today's Safer Retirement Radio right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
Do you want your retirement to be affected by who is in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott, 833-707-3030. If you have questions, you have concerns, maybe we're not even talking about something that concerns you about upcoming retirement or you're already retired, give them a call. See if they can help. 833-707-3030. Those are pretty staggering numbers, Brian, that Arrin just walked through by doing Roth conversions. The $1.4 million I'm ended up with, or the taxes I'm going to pay that much, compared to the, 4-point-something million that I would get if I did the Roth conversions. It's pretty impressive.
That's right. And we want to make sure that people know there's a right and wrong way to do Roth conversions. So let's talk about the calculations that we do. So Arrin, for example, if a client has total taxable income of $130,000, they're married filing jointly, we take away their standard deduction, that's $100,000. AGI, adjusted gross, we look and see at their tax bracket, what tax bracket they're in, and how much headroom they have before they go on to the next bracket. We do that calculation, then we look at the IRAs to see how much we can convert from IRA to Roth each year. So that's how we mathematically do the calculation. And then, Arrin, talk about what accounts we would convert and which ones we definitely would never think of converting.
Mm-hmm. Yeah. So you got to make sure that when doing IRA to Roth conversions, you're doing it with the right money, especially of when you're going to use it. So sometimes people will do Roth conversions, get money into that Roth IRA account, and then spend the money a year or two later as income. That really kind of defeats the purpose of doing a Roth conversion. The goal really is to be able to get as much value out of those assets as possible. And so when doing those Roth conversions, you want to make sure that you're doing that on dollars that you're not planning on touching here in the near future. So with the plans that we build here at Decker Retirement Planning, where we focus those Roth conversions is in what's called the risk bucket. These are the funds that are in those stock market strategies, and we do not touch the funds in these accounts for a considerable period of time, 10, 15, 20 years, because we want to get the long-term compounding for those Roth IRA dollars. Again, if you are doing an IRA to Roth conversion and spending the money in the next couple of years, you don't really get any advantage out of that. And so for the funds that are in those principal guaranteed accounts, buckets 1, 2, 3, and so on, we don't do IRA to Roth conversions in those accounts because you're using the money too early and you don't have the long time horizon to be able to compound those tax-free dollars for use later in the plan.
Okay, let's talk about some other strategies that a good advisor should be conversing with. Let's say that someone has a spike in income and we want an offset. We have an account and a strategy with a donor advised fund, how to properly use that. And Arrin, let's say that someone has huge capital gains. Let's say that a dentist client bought the building a while ago and bought Apple, Amazon, Netflix, Google, and Apple 20 years ago also. Huge capital gains on real estate and huge capital gains on stocks. And he doesn't want to pay it. We have a strategy that can zero out the capital gains and create an income stream for life. And Arrin, there's some more here. Let's say that someone's got a huge gain in their company 401k with company stock. There's a way that we can bring the taxes down on that. And let's say that they live in a state with estate taxes. We have strategies that can eliminate or greatly reduce their state tax exposure with strategies that we have in place. I'm going to leave you an easy one here, Arrin. At least this is my favorite. Why don't you talk about cost segregation and the dynasty trust? Those two are huge favorites of mine.
Mm-hmm. Yeah. So cost segregation is specifically for people that have rental real estate. So whether it's residential or commercial real estate, you're going to be familiar with the depreciation benefits that you get tax-wise, where you get to write off a portion of those properties, either over a 27.5 or a 39-year period. Now, by default, most people will take that depreciation in equivalent increments, just over that 27.5, 39-year time period. But that isn't the only option that you have as far as how to use those. So what cost segregation does is it allows you to be able to accelerate usually 25 to 30% of the property purchase price and use those depreciation benefits within the first 1 to 5 years of owning the property. So the way this works is you have a third-party company come in, they do a custom study on the property because different pieces of that are going to have different useful lives. You're going to walk on the carpet, you're going to use the appliances, but things like the windows or the framing or the roofing isn't going to wear out quite as fast. So again, once they do that study and break everything out, you can typically take about 25 to 30% and use those depreciable benefits within the first 1 to 5 years of owning that property. So it's a great way to be able to accelerate those versus waiting 25 or 30 years to get a portion of that depreciation benefit for owning that property. So again, that's for real estate. For the dynasty trust, this is one that's specific for helping clients have a little bit more control or specificity around where or when the assets are going to go after they pass away. So a lot of times people will take a traditional route where they just say, hey, I'm dead. All of the funds that I have are going to get distributed equally among all of my beneficiaries. But that isn't the only way that you have to be able to use or distribute those assets. So what a dynasty trust does is it allows you to be able to put various stipulations in for the things that are important to you. So maybe you have beneficiaries that you're like, I really don't want to dump this pile of money on their lap right when I pass away. I want to try to spread this out. So instead, you maybe give them 25% at the point in time that you pass away, 25% 5 years later, 25% 5 years later, and the remainder 5 years after that, kind of stagger it over time. Or maybe you have specific things that you care about that you want your beneficiaries to be involved in, to put some assets towards. Maybe you want to set up a fund that is specific for educational expenses or for charitable giving or for home down payments or whatever purpose is important to you that you want those assets specifically to be used for. So essentially a dynasty trust is kind of carte blanche, whatever's important to you, both specific purpose-wise or timing-wise. It allows you to be able to lay out how those assets are going to be used after the point in time that you pass away.
Right. And a dynasty trust allows you to skip the huge 48% generation skipping tax. If you think that you could just send money to your grandkids, any amount, that's not reality. So dynasty trust allows you to stipulate, you create it while you're alive and you list it as a beneficiary, and it's per stirpes, meaning it stays bloodline. So if one of your great grandkids gets divorced, this can't be counted as part of the divorce assets. It stays bloodline. And it distributes based on whatever you want. Like normally, like Arrin, you talked about, it can pay a percentage of tuition and books. If they go to school, if they don't go to school, they get zero. It pays a percent of their first home or first baby, first wedding, and college. So it allows you to stipulate how the trust would pay out if they assume responsible behavior. And if they don't go those routes, then they get nothing.
So, as always, here on Safer Retirement Radio with Brian J. Decker and Arrin Wray today, glad you were with us. I covered a lot of ground. If you'd really like to find out, well, everything they were talking about, how does it pertain to me? Because that's really what you care about. How does all of this pertain to you and your situation. Should you take advantage of this or that? Don't really know. Give them a call. There's no cost to do so. It's 833-707-3030, 833-707-3030. No cost, no obligation, no pressure, no judgment. The team's here to help if they can. 833-707-3030. Thanks for being with us this week for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. We'll be back with more next week. Thanks, guys.
Thanks, Mark.
Thanks.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.